Okay, hello. Here it's a chart example of the setup. So the setup basically you it's analyze the market and find the current trend. So in this case the market was moving on a downtrend. So when the market is moving on a downtrend we wait for it to reverse that trend. So meaning we wait for a change of character of the downtrend. So after finding the change of character, we mark the last price, the lower low as our liquidity. So we then, after marking our liquidity, wait for the market to come back and sweep the liquidity, and then pull back inside to show that the market with an efficiency move. So once the market hit liquidity, we wait for the market to react to that point with a pullback and imbalance. So many you should see bullish candles, two, three or more bullish candles after the market has tested the liquidity. So it's just like a quick pullback. So and then we mark the order block of that pullback as our point of interest, and then we wait for the market to come back and test that order block before we can think of taking an entry. So if you can see here the market was going down, down, down. Here the market was on a downtrend. After this, the market then changed the character, meaning changed this downtrend and start making an uptrend. So the market changed the character. So here was our change of character. This is our change of character. After the market has broken this level, the market was now changing the character, meaning it's now changing the downtrend to an uptrend. So before we can enter for the uptrend, we wait for the market to come back to the lower low. Lower low is the last price after the market has made its change of character. So after the market has made its change of character, you then go and mark the lower low. In the case of bullish, the lower low is this last price. This is our lower low. Why are we marking our lower low? The lower low is a stop loss of the smart money traders, because most people now they know that okay, the market has changed character. It is likely to come back and buy on the order block. So if the market comes on the order block and buy, then they put their stop loss on the lower low. However, the market will want to sweep that stop loss as liquidity to fuel price. So instead of you buying on the order block, wait for the market to come back and sweep the liquidity, the lower low. After sweeping the lower low, we wait for it to pull back with an efficiency move. Efficiency move means the market has moved impulsively, like it has made clean candles, just one color. So in this case, we're looking for an efficiency move of bullish. Bullish efficiency moves mean the market has printed three or more candles of bullish without printing any bearish. So in this case, this happened, and then you wait for the market to come back to the order block, and then that order block you treat it as your point of interest for entry. Sometimes the market will bounce once, sometimes it bounces twice on the order block. So then you can decide, you wait for the market, you buy on the first touch or you buy on the second touch of the order block. But in this stage now, you know at least you have 70% that the market will then move up to the high, the higher high of that trend. So if you can see now, the market was coming down, changed, and then moving up. So this video illustrates the chart example of the setup. And this setup is on the step index. In the step index, if you can see, yesterday I posted a screenshot let's switch on to H1. You see on H1, the steppeness hasn't swept the liquidity on H1. So we know that if on H1 the market still got to push back to touch that lower low. However, the market, we having that in mind, but we were able to go to M5 to scale for entry. So if you can see, we have these highs, these highs, these highs. So we are looking how market is going to react on these highs. Still this high, this high, this high. So as you can see, even if the market is going up, we know that in the larger picture, the market still got power or has still got a chance to come back and take that lower low. So if the market doesn't take that lower low, it will break our change of character and that high above, and then we analyze again. So basically, if you find a setup like this, a change of character, rather than trading on the order block of the change of character, wait for the market to sweep liquidity, and then if market sweep liquidity, you study that sweep and validate it. So maybe sometimes the sweeps are different. Some they come like with low momentum. Say when the market touches liquidity, it bounces back on the liquidity like multiple times. Yet a valid sweep is the sweep that the market will touch the liquidity and immediately retrace back. So but we discuss that as the time goes on. For now, I wanted to show you a chart example of the setup. So have it in mind that as time goes on, we will have a greater understanding of this. Thank you.